I would say the marketability of what you're buying whenever you sell it later. One thing that comes to mind is the specific location that you're buying in. I was on my spreadsheet from each house is supposed to make me 250 bucks a month, but in reality, it wasn't. The reason why it wasn't is because
Hi, I'm George Pino, the CEO of Commercial Brokers International, and thank you for joining me today. Today, I have a great guest. It's Joe Fairless. He's the co-founder of Ashcroft Capital, sorry about that, which has over $2.7 billion in commercial real estate investment properties that they manage. In addition to those, he also has a podcast called The Best Real Estate Investing Advice Ever Show with over 500,000 downloads a month. In fact, we'll have those backlinks for anyone who's interested in connecting with them as well. But also, one of the things I really love is, we like to work with people that we enjoy and like and appreciate and respect. And Joe and his wife also created Best Ever Causes, which is a community that supports now 72 different nonprofits over the last 65 months. So, and maybe we'll touch on that as well in case anyone also wants to, do a little bit of charitable donations, time or money, whatever it may be. So, Joe, thank you for joining me today.
well, I'm looking forward to our conversation, George.
Likewise, likewise. A lot of times when we speak with investors and talk to investors, there's many times there is a perception in the community. No, no, I shouldn't say the community. I should say within the U.S. that if you are a commercial real estate investor, it was given to you. That your family, you just were born into it. Your family gave you money. You were able to invest and do all this. Now, sometimes that's the case, but most often it's not. And a lot of times, and whether or not that may be the case here or not, to get to 2.7 billion in assets, that's not ever given to you. That's hard work. So, how did you get your start, Joe?
I got my start investing in a single family house.
Okay.
I'm from Texas originally, moved to New York City after I graduated college, and I was living in New York City, making $30,000 right out of college with $15,000 in student loan debt from Texas Tech University.
Yeah.
And I was I kept my living expenses low especially for New York City standards. 9 out of the 10 years I had a roommate. The first year I didn't, but the last 9 years I did. The first year I didn't because I didn't know anyone when I moved to New York City. I moved there to compete with the best of the best in advertising. That was my major in college. And so as you can imagine, my check was about like 750 bucks every 2 weeks I would get. Needless to say, I wasn't investing in any commercial real estate at the time. Instead, I was just trying to save my money. And eventually, as I was climbing the corporate ladder, I was able to save up enough money to then buy my first single family home as an investment property. So I was living in New York City and I bought my first single family house in Duncanville, Texas, which is south of Dallas, about 15 minutes. And it was for $76,000. I saved up 20K to purchase it, and that was in October of 2009. 2009? Yeah. Yeah. October of 2009 is when I purchased it. And then, I bought a house after that in 2010, another in 2011, another in 2012. And then I realized that on my spreadsheet, I was making 250 bucks a month, which was great. But in my bank account, I was not. And that was from each house. I was on my spreadsheet from each house is supposed to make me 250 bucks a month, but in reality, it wasn't. The reason why it wasn't is because, well, people would move out. And when they move out, it would cost money to get it move-in ready again.
Hmm.
And that would wipe away the profits from the year of, the 250 bucks a month. And so I realized I need to do something a little bit more scalable so that I could um, have better cash flow. And at the same time, while I was thinking about that, and I still have my full-time job in New York City, but I was investing in Dallas Fort Worth. At the same time, I started teaching a class on how to do what I was doing because my friends were wondering, "Hey, man, you're working 9 a.m. to 9 p.m. Monday through Friday at the advertising agency. How are you doing this?" I said, "Well, I'm buying these homes. Like, you're a landlord? What, you rent an apartment. You're in a two-bedroom apartment with a roommate from Craigslist with no AC. One of the rooms doesn't have windows, so I would have a washcloth that I would put on my forehead from the fridge. And then in the middle of the night, when it got warm, I would take the washcloth, put it in the fridge, and get another washcloth and get it and put it on my forehead to cool me down in the
Yeah.
summers. Like, you're living like a college kid. How are you buying these homes?" And I told them, but eventually I taught a class on it on the weekends on how I was doing it. And I heard from one of my former bosses at the time, he said, "This is interesting, but I don't want to deal with these homes. If you ever do something larger, let me know." So I realized that I had customers before I had a product. And that's when I started looking at multifamily in particular.
Okay. Okay. So, and it's very a lot of similarities. We started myself. I started investing with single family homes. Went into multifamily assets, and then went into commercial retail. And
Nice.
one of the things I think, first of all, amazing, and just the fact that from in the last 14, 15 years from 2009, what you're saying roughly, you've amassed a portfolio with your partners of over 2.7 billion in assets under management, which is a huge accomplishment and obviously not given to you. And in fact, actually, one of the things that strikes me um, is I hear this often, especially in the last 5, 6 years, work-life balance. And one of the things that really struck me is, and because this has always been my philosophy, is that, when you're younger, I was taught when you're younger, you put in your hard work, you put in everything so that you can have a better life down the road. And I think that's where a lot of people look at work-life balance. They look at it as a snapshot. Do I have balance today? Well, it's not, life isn't doesn't work that way. And in reality, you're putting in your hard-earned dues, like you said, no AC, you're putting that little the wet towel over your forehead to keep cool. And I can only imagine. I remember, my special treat was going out and getting takeout fried rice when I started off working, and it was only $3.50, but that was my treat, and everything else I was like eating like I lived like a college student, exactly that.
Mm-hmm.
And but now, I would argue that you and I probably have better work-life balance than other people our age. Because we have a little bit more of the freedom to do what we want to do, to spend the time with the family and the children that we didn't have in our 20s. And I see this repeat over and over with a lot of the investors that have really um, done well and taken off,
Mm-hmm.
in that they're making this early sacrifices, and people don't realize that that's a key component. But with that being said, what would you say is one best piece of advice for an investor, when they're just the best piece you could think of, whether they're a new person or a little bit more astute or whatever?
Well, I'll say the advice and then I'll share some logic behind it. The advice is to focus ourselves on 50-50 goals. 50% of the goal is achieving the goal, and 50% of the goal is knowing that regardless of if we achieve that specific goal, that will still come out ahead because of who it will help us become along the way of trying to accomplish that goal. So it's beautiful because you're always going to be set up for success. Even if you don't, let's say you have a goal of, I want to buy a property, a 100-unit apartment building in 12 months. Let's say you don't accomplish that. Well, if you think about it as a 50-50 goal, okay, well, that was half of my goal. The other half of the goal is outlining what are the things that I've done that have gotten me closer to accomplishing that goal over this period of time.
Mhm.
And that allows us to continually have momentum and build progress. And that is the logic behind the 50-50 goal is that as long as we're seeing progress, as long as we're getting momentum, well, it could be small momentum, it could be large momentum, but as long as there's momentum, then we'll feel better about what we're doing, and that will help us continue to stay in the fight, like stay in the game and continue to progress.
Sure.
And that is where a lot of people fall out of the race, fall out of the game, is
Mhm.
they have a big goal, they don't accomplish the goal, and then they stop trying to accomplish the goal, or they find some shiny object and they go a different direction. Whereas if we approach it this way, then we'll constantly be making progress along the way, and eventually we'll figure it out. And then that 100-unit property that we eventually buy, maybe in 24 months, not 12 months, the next 100-unit property will happen in 6 months. And because we'll have stayed in the process and continued with that momentum.
Mhm. Okay. I love that. I love that the fact that you're looking at it from a more of a positive viewpoint in that you're looking to try and get the um, some sort of experience out of it. And what I think is great about that is you're always analyzing what you're doing so that you can also do a better job.
Mhm.
And that also kind of falls on, one of my pieces of advice I always give investors is that this type of investment is not a one and done, unless
Mhm.
of course you're passive. And a lot of investors, even those that have large portfolios, they purchase a property and they think they're done with it and they never really analyze what's going on. On the other hand, when people call me, I get calls all the time. Would you sell your property? And my response is, I'll sell any property at any time. And I have. I've even sold my home, not on the market. Someone knocked on the door, approached, and said, "I'd like to buy the house. I want to give you this price." I was like, "Wow, that's 20% over market, honey. We're moving." Um, and but I seriously, that was way back in 1993, I want to say, or 94. But I'm always looking at that. And when it comes to our investments, I'm always analyzing it, meaning, is this investment doing as well as it can be doing or should be doing, or is it doing better than a different type of investment if I were to sell this and transfer into it? And so this way, I'm always maximizing my returns, whether it has to do with even repositioning on a 1031 exchange so I can increase basis to get more tax depreciation. Whatever it may
Mhm.
be on those investments, I'm always calculating, looking at it. And I think that that's something a lot of investors forget to do is, like, oh, I'm getting this return, I'm getting this return. Oh, this year it did okay, but not as good as last year. And they don't really look at, well, what are the alternative investments I can go into then if I were to sell this? And I think that's a key component because you're doing this specifically for an investment. This is not a emotional purchase. You're not purchasing anything along these lines that, for the most part, shouldn't be an emotional purchase. Now, that being said, I know I made a lot of mistakes getting started. And I'm sure you probably made a few as well and learned from it, whether it's the make ready costs, expecting not to be as high or whatever the case may be. But what do you think is often overlooked for new investors when they starting investing?
Active investors, like operators,
Hmm.
what's often overlooked is the a skill set that they don't have. Because in commercial real estate, there are three components: money, deal, and execution. You have to have the money to buy the deal, so you have to have a deal, and then you got to be able to execute the business plan. And what is often overlooked or um, trivialized to the detriment of the operator is that he or she is good at one area, maybe even two, but they're not good at all three, and they're not exceptional at all three. And so they might have a really good opportunity, but can't get it to the finish line with equity. They might have the ability to rally and galvanize investors, but they can't find or they can't assess the right opportunity. They can find opportunities. They think they're good, but not so much. And then they get into a hornet's nest once they close, or they might find a good opportunity, might build a lineup to equity, but then you know, they think the job is done, as you
Yeah.
mentioned, and they move on and they don't focus on the execution. And so, as a beginning investor, my suggestion, based on the mistakes I've made and the lessons I've learned, is to look at yourself in the mirror and say, where does my background uh, lend itself towards in those three areas: money, deal,
Mhm.
execution, and can I compete at the highest level in one of those three areas? And if I can, then the other two, one or two areas, I need to go find some qualified people who have a vested interest in the successful execution of the business plan for the deal that I buy.
Okay. Now that makes sense. I mean, I actually really like that is identifying, I think the hardest part there is probably identifying where you are weakest because a lot of people don't like to look in the mirror and say, I can't do that. And,
There's a the book
but
80-20 rule, I think it's Perry Marshall. There's an exercise in that book where the author writes about, hey, go reach out to five of your closest friends, and ask them what you're good at and what you're not good at, and then get some feedback, or and reach out to some coworkers too, or some former coworkers,
Mhm.
and gather that, because you aggregate those responses, you'll be able to tell what's working, what's not working for you.
Absolutely, absolutely. And human nature, as I learned this was wrong from way back, is in my mind, I was the greatest person ever in college.
You were perfect. You're
So
absolutely perfect,
exactly.
flawless.
And so I think that's great advice. I would probably maybe even throw out that when I talk to a lot of times first time investors, I ask them if they even have a business plan. What are they going to do with this property? How are they planning on doing it? And so this way they have a roadmap at least of
Hmm.
what they can expect, and then if they can identify what their weakest part is, whether it may be bringing a management company or whatever in there. Now, as we go forward, I also know that, even after, we did quite a few syndications, but we still made mistakes. And learning from those mistakes and being able to recoup from that is probably one of the best attributes an investor can have because nothing ever goes perfectly. But what do you think that for experienced investors, what's often overlooked that they should be taking into consideration?
I would say the marketability of what you're buying whenever you sell it later. One thing that comes to mind is the specific location that you're buying in. On our second property that we purchased, it's in an area, we sold it, was in an area called Greens Point uh, of Houston, and locals call it Guns Point, to give you an idea of the type of area. And it was a challenging property. The first property we bought at Ashcroft was not challenging and in a really good school district, barely in a good school district, but in a really good school district with the county line or the school district lines. The second property, not so much. And fortunately, we were able to grow NOI, but I mean, it's next to a gas station. I mean, just the location of that specific property was tough. And um, over, we underestimated the specific spot the property was in. We thought, okay, it's in. We didn't think it would make that much of an impact on the property and operations, but it was a tough property, and so we stopped buying those in those areas as a result, and that makes it more marketable for
Mhm.
buyers on the exit. So keep the end in mind, and pretend, if you're going to be a buyer of your property, what would you want? Well, in our world, you want some value add still at the property. So we don't renovate usually. We usually don't renovate 100% of the units. We renovate, say, 50 or 75% of the units. We want to buy in a really good school district. So some of the fundamental things that will increase the buyer pool, and that's the key, increasing the buyer pool so that you have more buyers, bidding, and therefore, in theory, that increases the price that people pay for it.
Okay. So really what, I mean, to sum it up, and correct me if I'm misspeaking here, but really you're focusing as much attention on the exit strategy as you are
Yes,
on the acquisition. And
absolutely.
I think that's a very wise strategy to utilize when coming to investments because, a lot of times you want to know to try and mitigate the risk, especially in commercial real estate, if you're doing like single tenant net lease or a lot of big box with long-term leases, who am I going to bring back in? How am I going to reposition that lease to create the value when I go to sell it after my investment horizon expires or, estimated hold period? And, I think that's really key.
Mhm.
Now, we've covered a lot of ground here in the last 20, 25 minutes or so, but quick question for you. Um, what if I'm sitting there and going, I have 50,000, $100,000, not quite enough necessarily to go into a commercial real estate investment or investment grade type property, maybe more residential. Um, what are my opportunities? I mean, there's definitely, would you recommend maybe going in under a passive investment so that you can learn a little bit about what they do or how they're looking at it, whether it's a syndication or maybe even a REIT?
It depends on the goals of that individual. It depends on your time commitment. Because if you have a lot of time and you want to learn to be active in the business, and if you got 50,000 to $100,000, and you know, and you want to do the best approach, in my opinion, go buy a fourplex, live in one of the units, and rent out the other three under a favorable loan because it's
Mhm.
still residential, and then go do that every couple of years, whatever the loan covenants allow. So it just depends. If you don't want to spend time on the business and you want to invest passively, but you want the benefits, the tax deferred benefits of real estate, then yeah, I would say invest passively. I'm an investor on 123 deals right now as a passive investor. So, I don't just talk the talk, I walk the walk.
Yeah.
And it's great because, I get the tax benefits on most of the deals, assuming the operator passes depreciation through to the investors. And it's a great way to experience what's going on. So I'm one of our Ashcroft Capital, my company, I'm one of our largest investors, but I'm also invested with 56 different operators
Hmm.
passively. And that helps me as an operator get better and learn what works and what doesn't work with other operators.
Absolutely. I mean, there are definitely synergies to size. And, I think what you just said is probably, I would argue, probably one of the best and most important parts of this interview, in that you working with other investors makes you a better investor for yourself, whether even on the passive side, because, I think overall, when it comes to investments, there's a lot of fluidity with them. Things change, economics change, what you see, there's a lot of investors who started, um, you know, right after the last big downturn, and they've only experienced upside potential, and a lot of them have lost most of their equity or a lot of their equity, if not everything, in this recent downturn. And it's understanding those cycles and predicting and where they happen, because ultimately, this is a fluid market. There will be ups and downs. We're not always going to go up and down, but more importantly, as things change, we have to learn how to adapt to it. And I love your answer there, that by being a passive investor in other groups, that you're learning there as well. So that's just improving your own game for your own investments as well. And I love that. I think that's probably the best advice in this whole video right there. But I'm a big fan of education. So, Joe, I want to say thank you so much for joining us today. It was pleasurable. It was a lot of information, a lot of good information, I think, for both newer investors and those with some experience as well. And don't forget, best ever causes. If you are looking for some good charitable organizations that you can work with, you can go directly through the best ever causes. We'll make sure we have that link. That is created by Joe and his wife. What is your wife's name, by the way?
Colleen.
Collie?
Pauline, Colleen.
Colleen. Oh, nice.
Colleen.
Well,
Yeah,
Joe and Colleen. You know, I have good friends that are both husband and wife, Joe and Colleen.
that's
Uh,
funny.
so out here.
That's cool.
Yeah, so that's great. And also check out his podcast, Best Real Estate Investing Advice Ever Show. Just from the snippets we've seen here, I think he's going to live up to that title. So check that out and look forward to having you again at some time.
Yeah, and I'll say that if you're interested in looking at what we're doing at Ashcroft, you can go to ashcroftcapital.com.
Absolutely.
You mentioned at the beginning of this show, we have almost 3 billion in assets under management. They're all apartments. What I'll say is we have 1.1 billion in equity that we currently have invested with us, that there's currently invested with us, and that's across over 3,500 accredited investors who
Okay.
invest with us right now actively. So we have a deal in Orlando you can check out by going to current offerings under our
Okay.
website, ashcroftcapital.com.
Great. Sounds good. And if you're watching this video later on, just check out the current offerings anyways, because there's going to be another opportunity for you. All right.
All right. Thanks,
Uh,
George. Thanks, everyone.
thank you.